We have, after an opening panel, an opening presentation. It is on the theme of private markets, allocation trends and drivers. And to deliver this update, it's my great pleasure to introduce Francois Aguerre, partner, co-head of investment at Collar Capital.
Thank you so much. So good morning, everyone. Welcome to this session. It's only 15 minutes. There's a lot of slides I'm supposed to go through, so I will probably skip through a few of them and spend a bit more time on others. Even though it's only 15 minutes, if you have a question of any kind, please feel free to ask. There are big flashes coming this way, so maybe you need to stand up so that I don't miss you there. Any chance we get the slides on? Fantastic. So the barometer, just to put in context, for 18 years, twice a year we do an independent survey to the LP community. So everything you're going to see today is feedback from the LPs, nothing to do with Collar, we're just the conduit for that survey. It is being done across, sorry for that, many LPs from all around the world. All type of LPs, sovereigns, pension funds, family offices, large LPs, small LPs, recent LPs, old LPs. So you got really the overall community of LPs which is represented. And so just to put in context as well, and that survey was done at the end of Q1 of this year. So the way to think about it is that probably all bad news were not yet in the system for the LPs, but equally the war had started, inflation was there, raise of interest rates was already in the foresight. So some bad news was nonetheless already captured by the LPs when they filled up that survey. So if we go first, we will talk about a little bit returns, allocation, those concepts, then we'll talk a little bit about ESG and maybe a bit of private credit. So when you look at that, what you see here is allocation trend and returns trend. So on the left-hand side, this picture is a picture which has been very, very consistent since the global financial crisis, i.e. the majority of the LPs, or a majority of the LPs, reducing their allocation on a proportionate basis to the hedge fund industry. You may have in mind that the hedge fund industry is growing the AUM, but basically slower than everyone else. And a lot of the allocation going to private markets in general. What you can see is that across private equity, infrastructure, debt, real estate is just going up. One point which is interesting is that so 50% of the LPs willing to, in the next 12 months, willing to increase their allocation to alternatives, and so private markets in particular. This is the second highest percentage in the history, 18 years in the history of this survey. The previous time was 2007. When you look at the returns on the right-hand side, what you see is that consistently for a number of years, a lot of people have said for the last 10 years, easy money, you can make a lot of returns. And so 80% getting double-digit returns. For the first time, you were getting to 90%, and also for over 40% getting 16+% returns. So those returns are since the inception of the program of all of those LPs. Right? So if you started your program 20 years ago, and if you're in this blue category, it means that over the 20 years, you have overall over 16% net IRR return on your program. So here again, that number, over 40%. This, only one time it was higher. That was in 2007. So those numbers will go down. Obviously, all of you should expect that with declining markets this year, but also the recession coming, some of the portfolios companies starting to suffer. So I don't know who's GP, who's LP, who's else in the room. We see hundreds and hundreds of funds everywhere, and I can tell you there are a number of portfolio companies which are starting to struggle a little bit. So that would readjust. But nonetheless, the 80% is actually quite stable, irrespective of crisis and so on. So the asset class is praised for a reason, which is that it does outperform every other asset class, even on a risk-adjusted basis. So looking now briefly at, again, another way of looking at allocation, not surprisingly, portfolios have outperformed the public markets. That's on the left-hand side. Of course, that's the case. Otherwise, none of us would have a job here. There is also clearly an important outperformance for higher allocation versus lower. The survey you got here from Cambridge is 200 basis points. If you go from 10% to 30%, just to give a sense of the benchmark. And what you've got on the right-hand side is basically most of the LPs' feedback being that they are outperforming meaningfully the target returns that they have. That's the feedback. Their portfolios could do much worse and still would be in line with the target returns. So the LPs are fairly happy, and as a consequence, they want to increase the allocation. All of this goes in circle. On the access side, which is also related to the allocation, this one is still a new trend in the industry, but it's not very new, and it will increase meaningfully. So this is the fact that the industry is trying to get access more and more to a different type of capital. So you would have heard for a long time now private bank coming into the industry. It started with very high net worth individuals going to not so high net worth individuals, then affluent, and then retail. The forecast being that 2025, 10% of all capital coming in private markets will come from that area. Not surprisingly, it will be very uneven between GPs. I'm sure you would have heard from some of the leading GPs where the target is already 50% of the capital coming from that area. And so on the way LPs think about it is, as you can see on the chart, is it a problem for access, i.e. is it competition for access? It's not that straightforward. If you think about it, if you're a GP, you're going to be thinking that this capital is a capital where there is maybe a bit less of negotiation power to come into your fund, but actually the distribution is expensive to reach that capital. So in terms of profitability between a pension fund or retail, the comparison is not that straightforward. So competition on access is not necessarily the issue. Potentially the issue is impact on returns, because then you serve a pension fund with specific return targets. The retail investor most likely will have a lower return target because their opportunity cost is clearly lower in terms of access that they have from an investment perspective. So the next one I'll skip just because of time constraints, but basically increasing allocation. In terms of the first closing, I'll go quickly because it's also quite intuitive for the first two results. You give an incentive to the LPs, economic incentive to the LPs. They come into the first close. Not too surprising there. If you are a very in-demand type of fund and GP, they will come to the first close to try to secure their allocation. Not particularly surprising. The third one is a bit more of a surprise. I was having the conversation yesterday. What the third one is saying is that basically, as a GP, even if you do nothing, you will have actually a number of LPs coming into the first close because irrespective of you, it just works with whatever timetable they have and how they want to allocate that work. And this is 68%, so it's not irrelevant as a number. So just to bear in mind in this negotiation power between the LPs and the GPs. So a few words on ESG. ESG, so good news in a way is that there is clearly some consensus in the LP community. This is a 65%. Some consensus that ESG is useful in two respects. First one in terms of just positive changes in portfolio companies, which are good for the companies, good for the returns. So that's something which is quite important. And the other one is that it is a good risk management tool. It's not the only one, but it's a good additional tool on on the risk side and appreciated by the LPs. In terms of industries, so what this slide shows is the general theme, which is that ESG in Europe has always been, to date, stronger compared to, I think it's for you, compared to US and Asia. So here it's no surprise. It's just trying to give a little bit more of a narrow perspective on the sectors in particular. And what you can see is that Europeans are a bit more reluctant to invest in some sectors which they feel are a bit too high on the risk spectrum. So there is a consistency between US and Europe on pornography, for those interested. But overall, Europe is higher up. Another component on the ESG side, which is on the environmental component. So here again, no surprise, climate change is really at the top of people's mind. And for many LPs, it is the case because it's really coming from the top. So many of the LPs are public institutions, one way or another, subject or influenced by the political environment. And there is so much pressure coming from most of the governments in most of the developed or developing countries that you end up with a clear focus of the community on climate change. So one additional topic on the LP side is the difficulty to hire talent. So that component, everything is happening at the same time. Salaries are going up, financial industry. This is the consequence of COVID as well, where you've got a proportion of the population who just want to do something else, and the industry which continues to grow irrespective of the environment. So it is getting more difficult. We're having the conversation yesterday evening. So you need to adjust your salaries. You need to adjust the working conditions. Give you just one example of a pension plan in the UK, not based in London. It's a team of 4 people. At this point, only 1 person lives in the city. They had to recruit the 3 other people all across the country because there was just no talent available and no one willing to move to that place for the job. It's working, but it's 4 people all over the place managing a number of billions. It is a challenge for the LPs. So this one I pass. All of us here with suits, some of us with tie. It's been 150 years on the male side in particular. It's not changing anytime soon. Thank you for the jeans. I do appreciate. We need to make some progress. And finally, a quick word on credit, on private credit. As the views are quite balanced. They are quite balanced because, of course, in a way, interest rates are going up. If you are floating in your credit strategy, you will benefit from it. And so some people may be long on credit, but it's not always the case. What you've got on the next slide, so I'll go quickly because I got 5 seconds. But on the next slide, what you see is expectation of default rates going up. It's only a minority of the LPs, but nonetheless, we don't know it will happen. We know it's already happening. And so there is some quite a mixed view at this stage on direct private credit. So of course, whenever you've got that, for people who do coincidentally secondaries in private credit, it's a great opportunity. And on this, I conclude.